There is a powerful and dangerous myth that governs the world of money. It's a story whispered in the frantic closing bells of the stock exchange, a tale told in the grim expressions of news anchors during a market downturn, and a belief held deep in the hearts of millions of retail investors who watch their life savings evaporate in a sea of red. The myth is this: that bad news is a signal to run, that a crisis engulfing a company, a negative headline, a plunge in the stock price, that these are omens of doom, signs that the ship is sinking and that you must get to the lifeboats before you're pulled down into the abyss. This myth is responsible for more destroyed wealth, more shattered dreams of financial freedom, and more sleepless nights than any other force in the financial world. It turns ordinary people into panicked sellers at the absolute worst moment, forcing them to sell low what they so often bought high, locking in their losses and ensuring they never experience the incredible power of true, long-term portfolio growth. But for a very small group of people, a tiny fraction of the investing world, this myth is not a source of fear, it is the greatest gift they could ever ask for. For them, bad news is not a fire alarm, it is a dinner bell. A widespread market panic is not a catastrophe, it is the single greatest buying opportunity of a generation. And the man who perfected the art of turning public fear into private fortune, the undisputed master of this contrarian investing philosophy, is Warren Buffett. He understood a fundamental truth that escapes 99% of market participants: the stock market is not a logical, calculating machine. It is a manic-depressive business partner. On most days it is stable, but on some days it is euphoric, willing to pay any price for a story of endless growth. And on other days it is gripped by a paralyzing, terrifying fear, willing to sell the crown jewels of American industry for pennies on the dollar, convinced that a temporary problem is a permanent death sentence. The entire foundation of the Buffett strategy, the bedrock of the Berkshire Hathaway empire, is built on one core principle, a single idea so powerful it can transform a regular investor into a master of their financial destiny. The principle is this: the most lucrative, life-changing investment opportunities arise when a truly wonderful, world-class company is experiencing a significant problem, a problem that everyone else in the market believes is permanent, but that you, through careful analysis, understand to be temporary. The costly mistake this principle prevents is the cardinal sin of investing: abandoning a phenomenal, time-tested business because of a single, scary headline, failing to see the vast, verdant forest of long-term earning power for this single, ugly, dying tree of a short-term crisis. The financial transformation this unlocks is profound. You will develop the analytical skill, the emotional discipline, and the CEO mindset to differentiate between a terminal illness and a curable cold in a business. This ability allows you to stride confidently into the heart of a market panic, armed with capital and conviction, and buy truly wonderful assets at bargain prices, precisely when others are consumed by a fog of short-term fear. This is not just a trading strategy, it is a complete framework for wealth creation. It is the key to achieving real, lasting financial freedom, and it begins by learning to see what others refuse to see. It begins by understanding the 5 pillars that support this entire philosophy, starting with the most crucial question of all: how do you even know if a business is wonderful in the first place? To truly grasp Warren Buffett's genius in capitalizing on bad news, we must first understand the foundation upon which his entire contrarian investing philosophy is built. You cannot buy a great company on sale if you don't have an ironclad, unshakable definition of what makes a company great to begin with. Without this crucial first step, you are simply buying cheap stocks, not wonderful businesses, at cheap prices. And there is a world of difference between the two. The first is speculation. The second is the path to building generational wealth. Buffett's first pillar is what we can call the fortress of intrinsic value, identifying a truly wonderful business. He is not interested in turnarounds, in speculative ventures, or in companies in hyper-competitive, low-margin industries. He is looking for businesses that are, in his words, economic castles protected by unbreachable moats. And the story that best illustrates his discovery and codification of this principle is the acquisition of See's Candies in 1972. At the time, Buffett and his partner Charlie Munger were still disciples of their mentor Benjamin Graham, the father of value investing. Graham's method was quantitative, a cigar butt approach. He taught them to look for statistically cheap companies, businesses trading for less than their net working capital, for example. You could pick up these discarded cigar butts off the street, get one free puff out of them, and then throw them away. It was profitable, but it wasn't scalable, and it involved buying often mediocre or even terrible businesses simply because they were cheap. See's Candies was a radical departure from this strategy. It was a family-owned, California-based chocolate company, and it was not a cigar butt. The sellers were asking for $25 million. Buffett and Munger looked at the balance sheet. The company had about $8 million in tangible assets, things like buildings, inventory, and equipment. Under the strict Ben Graham framework, paying $25 million for a company with only $8 million in physical assets was heresy. It meant they were paying a $17 million premium for something they couldn't see or touch: the brand, the customer loyalty, the reputation. Munger was initially skeptical. This was not their game. It seemed too expensive, too fluffy, but Buffett was beginning to see a different kind of value. He dug deeper. He saw a business that had an almost fanatical following. Customers in California didn't just buy See's for a chocolate fix. It was an integral part of holidays, birthdays, and celebrations. People who moved away from California would beg friends and relatives to ship them boxes of See's. This wasn't just a candy company, it was a cultural institution. And this powerful brand loyalty gave See's something magical: pricing power. Every year, the CEO, Chuck Huggins, could raise the price of the boxed chocolates, and customers wouldn't flinch. They happily paid because the value they received wasn't just the chocolate, it was the nostalgia, the quality, the gift-giving tradition. This pricing power translated into incredible financial results. The business generated high returns on the capital invested in it. It didn't require massive, ongoing investments in new factories or research and development to maintain its position. It was a cash-generating machine. Buffett realized that the $17 million of goodwill wasn't hot air. It was the most valuable part of the business. It was the economic moat. A competitor could build a new factory, they could hire chemists to replicate the recipes, but they could not replicate the decades of happy memories lodged in the brains of millions of customers. That was the unbreachable fortress. They bought the company for $25 million. Over the decades that followed, See's Candies would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital investment. It was the investment that fundamentally changed Buffett's entire approach. It taught him, in his own words, that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This story is the foundational anecdote because it marks the shift from a purely quantitative stock-picking strategy to a qualitative, business-focused one. It established the first and most important filter for all future investments. Before you ever consider the price, you must first fall in love with the business itself. The power of a business like See's Candies is rooted in a deep and predictable psychological principle: the halo effect. The halo effect is a cognitive bias where our overall impression of a person, brand, or institution influences our feelings and thoughts about its specific characteristics. When we perceive something as positive in one area, we tend to perceive it as positive in other areas as well. For See's, the halo was cast by decades of consistent quality, excellent customer service, and its association with positive life events like holidays and family gatherings. This positive overall impression, the halo, meant that customers automatically assumed each new box of chocolate would be delicious, that the ingredients would be high quality, and that giving a box of See's as a gift was a socially correct and appreciated gesture. This cognitive shortcut is incredibly efficient for our brains. Instead of re-evaluating the quality of See's chocolate every time we consider a purchase, our brain simply accesses the See's is good file and makes the decision instantly. This is the psychological engine of a powerful brand. It reduces the cognitive load on the consumer and creates a powerful habit loop. For a business, this is pure gold. It means reduced marketing costs, as your customers become your evangelists. It means pricing power, as the perceived value is far higher than the cost of the physical ingredients. It creates an enormous barrier to entry for competitors. A new chocolate company, Joe's Discount Choco, could set up shop next door to a C's and offer a similar product for half the price. But they would struggle immensely. They don't have the halo. A customer thinking of buying a gift for their mother-in-law isn't just buying chocolate. They're buying the assurance of quality and the avoidance of social risk. The halo of the C's brand makes the purchase decision safe and easy. Buffett understood that this psychological moat is far more durable than a technological advantage or a low-cost production process, both of which can be replicated or disrupted. The memories and positive associations built over generations are almost impossible for a competitor to assail. This is why, when he analyzes a business, he is looking for evidence of this psychological capture. He asks questions like, does the product command a premium price? Is the brand a verb, like Google it or Xerox it? Would customers feel a sense of loss if the company disappeared tomorrow? These are not questions that can be answered by a spreadsheet alone. They are probes into the collective consciousness of the consumer, searching for the telltale glow of the halo effect. Mastering the identification of this principle is the first step in any sound wealth management strategy, because it allows you to separate fleeting corporate successes from enduring economic franchises. So how can a retail investor, without Buffett's resources, translate this into a practical, applied mental model? The blueprint is Buffett's famous 4 filters for investment, a direct evolution of the lessons learned from C's Candies. This is the checklist you must run every potential investment through before you even begin to think about a temporary crisis or a stock price. Filter 1. Is the business simple and understandable? This is a test of your own competence. Buffett famously says he has a file on his desk labeled "Too Hard." If he can't, in a single paragraph, explain how the business makes money and why it will still be making money in 10 years, he passes. For you, this means avoiding businesses built on complex financial instruments, unproven technologies, or convoluted business models. If you need a PhD in biotechnology to understand a company's pipeline, it belongs in your "too hard" pile. Stick to what you know. If you're a teacher, you might have unique insights into educational software companies. If you're a mechanic, you might understand auto parts suppliers better than anyone on Wall Street. This is your circle of competence. Filter 2. Does the business have favorable long-term economics? This is the search for the moat, the halo effect in practice. The blueprint here is to look for tangible evidence. First, check for a history of consistently high return on equity, ROE, or return on invested capital, ROIC, ideally above 15%. This shows the business is effectively generating profits from its assets. Second, look for stable or rising gross margins. This indicates pricing power. If a company can raise its prices to offset inflation without losing customers, it has a moat. Third, look for a durable competitive advantage. Is it a powerful brand like Coca-Cola? Is it a low-cost producer like Costco? Does it have a network effect, where the service becomes more valuable as more people use it, like Visa or Facebook? Or does it have high switching costs, making it a pain for customers to leave, like the bank that holds your mortgage? You must be able to clearly identify and articulate the nature of the moat. Filter 3. Is the management able and trustworthy? You are not just buying a stock. You are becoming a silent partner in a business. You need to know who is running the show. The blueprint here involves reading the last 5 to 10 years of annual reports, specifically the letters to shareholders. Does the CEO speak plainly and admit mistakes, or do they use confusing jargon and blame external factors for poor results? Look at their track record on capital allocation. Do they wisely reinvest profits back into the business, make smart acquisitions, or do they squander cash on overpriced empire-building mergers or ill-timed stock buybacks at market highs? Check executive compensation. Is it tied to long-term performance metrics, or do they get rich even when shareholders are losing money? You are looking for managers who think like owners, because as a shareholder, that's what you are. Filter 4. Is the stock available at a sensible price? Notice this is the very last question. You only get to this stage after a company has passed the first 3 filters with flying colors. We will dedicate an entire chapter to calculating the right price later, but for now the principle is that even the most wonderful business in the world can be a terrible investment if you overpay for it. Applying this 4-filter mental model is the core of a successful stock analysis. It forces you to think like a business owner, not a stock market speculator, and it is the only way to build a portfolio of the wonderful businesses that form the foundation of the Buffett strategy. To truly appreciate the power of this approach, we must examine its antithesis, the path of the 99%. The vast majority of market participants do the exact opposite of the 4 filters model. They don't start with the business, they start with the stock price. Their process is driven by external noise, not internal analysis. They see a stock that is soaring, a hot tech company, a new cryptocurrency, a meme stock, and are consumed by the fear of missing out, or FOMO. They hear stories of neighbors and coworkers getting rich, and the psychological pressure to join the herd becomes unbearable. This is the path of buying story stocks instead of established businesses. The dot-com bubble of the late 1990s is the ultimate case study. People were not investing in businesses. They were investing in concepts. Companies like Pets.com, which raised $82 million in an IPO, had a catchy Super Bowl ad and a sock puppet mascot, but they lacked a viable business model. They were losing money on almost every sale because the cost of shipping heavy bags of dog food exceeded the profit margin. They had no moat, their long-term economics were disastrous, and their management was focused on burning cash to acquire customers at any cost. Yet people poured money into it. Why? Because the story was compelling and the stock price was going up. They skipped the first 3 filters entirely. They didn't ask if the business was understandable or if it had favorable long-term economics. They simply saw a rising price and assumed it must be a good investment. This is herd behavior in its purest form, and it always ends in tears. While these speculators were chasing Pets.com to its eventual bankruptcy, Buffett was quietly holding his shares in See's Candies, a business that was understandable, had a powerful brand moat, and was run by able management. The contrast is stark. The 99% chase what is popular and exciting, leading them to buy at the peak of euphoria. They mistake a rising stock price for a good business. The Buffett-style investor, by contrast, patiently searches for a good business and then waits for the price to become attractive. The antithesis is also seen in the obsession with cheap stocks based on a single metric, like a low price-to-earnings ratio. An investor might see a steel company or an airline trading at 5 times earnings and think it's a bargain. But applying the 4 filters would reveal that these are often brutally competitive, capital-intensive industries with no pricing power and no durable competitive advantage. They are fair, or even poor, companies that happen to be at a cyclical peak. Buying them is the classic cigar butt approach, and while it can sometimes work, it often leads to owning a portfolio of mediocre businesses that go nowhere. This is the path of short-term trading strategy, not long-term wealth creation, and it's a path that is littered with financial ruin. The direct financial connection between identifying a wonderful business and your portfolio's performance is profound and can be seen clearly on the financial statements. A company with a deep, wide moat, the kind Buffett seeks, has a financial signature that is unmistakable. First, look at the income statement. You will see consistently high and stable gross margins. A company like Moody's, the credit rating agency with a powerful duopoly moat, has gross margins often exceeding 70%. This means that for every dollar of revenue, 70 cents is left over after paying for the direct costs of providing the service. A company in a brutally competitive industry, like a grocery store, might have gross margins of 20% and be fighting for every penny. That high gross margin is the financial fingerprint of pricing power. Second, look at the cash flow statement. A wonderful business generates vast amounts of free cash flow, the cash left over after all expenses and capital expenditures are paid. They don't need to constantly reinvest huge sums of money into new machinery or facilities just to stay competitive. See's Candies is the classic example. The cash it produced could be sent to Berkshire Hathaway to be reinvested in other wonderful businesses, rather than being plowed back into the low-return candy business. This is the opposite of a capital-intensive business like an airline, which has to spend billions on new planes just to stay in the game. Third, look at the balance sheet. A great business often requires very little debt. Because it is so profitable and self-funding, it doesn't need to leverage itself to the hilt to finance its operations or growth. This makes it incredibly resilient during economic downturns. When a recession hits, the debt-laden low-margin company is fighting for survival, while the fortress-like business can play offense, buying back its stock at depressed prices or acquiring weaker competitors. This financial strength, rooted in the qualitative factor of a business moat, is what drives massive, long-term portfolio growth. It's the engine of compounding. A business that can consistently earn high returns on its capital without using a lot of debt will see its intrinsic value grow year after year. As an owner of that business, your wealth compounds along with it. This is the ultimate goal of any serious entrepreneurs or CEO mindset investor. It's not about quick capital gains. It's about latching onto a powerful compounding machine and holding on for the ride. Mastering this first pillar is non-negotiable. It is the bedrock. Only once you have a watch list of these fortress-like businesses can you move to the next, more opportunistic stage, waiting for the inevitable crisis that will allow you to buy one of them on sale. Once you have identified a portfolio of wonderful businesses, you enter a phase of patient waiting. You understand their moats, you trust their management, and you admire their financial strength. Now, you wait for the market to offer you a gift. That gift almost always arrives wrapped in the terrifying packaging of bad news. A product recall, a government investigation, an accounting scandal, a major customer loss. These are the events that create the disconnect between a company's long-term intrinsic value and its short-term stock price. This leads us to the second and perhaps most critical pillar of the Buffett framework, the curable cold versus the terminal illness, a diagnostic framework for corporate crises. The ability to accurately diagnose the nature of a corporate problem is the single most important skill for a contrarian investor. It is the difference between buying a world-class company at a temporary low and catching a falling knife that is a business in permanent decline. The average investor sees a headline and panics. The master investor sees a headline and begins their analysis. And no story better exemplifies this diagnostic skill in action than Buffett's legendary investment in American Express during the salad oil scandal of 1963. The crisis was something straight out of a Hollywood movie. American Express at the time had a division that issued warehouse receipts. Companies would store their inventory in an American Express warehouse, and Amex would issue a receipt guaranteeing that the inventory was there. Banks would then lend money to the company using these receipts as collateral. One of American Express's largest clients in this business was the Allied Crude Vegetable Oil Refining Corporation, run by a charismatic fraudster named Tino DeAngelis. DeAngelis claimed to have massive tanks full of valuable salad oil. The truth was far more devious. His tanks were mostly filled with water, with only a thin layer of oil floating on top to fool inspectors. He had created a phantom empire of oil, borrowing hundreds of millions of dollars against non-existent collateral. In November 1963, the fraud was exposed. Allied Crude defaulted, and the banks that had lent money against the worthless receipts were facing catastrophic losses. They, in turn, sued American Express, claiming that Amex had guaranteed the collateral. Wall Street panicked. The consensus was that American Express, a pillar of the financial establishment, was on the hook for liabilities that could potentially bankrupt the entire company. The stock price was annihilated, plunging nearly 50% in a matter of weeks. The narrative was clear: American Express was finished. This is where Buffett's diagnostic process began. While everyone else was focused on the screaming headline, the scandal, the fraud, the potential liabilities, Buffett asked a different question. Has the core value-generating engine of American Express been damaged? He knew that the warehouse receipt business was a tiny, insignificant part of the company. The real value, the economic moat, lay in two other divisions: the traveler's checks and the credit card business. These businesses were built on the psychological foundation of trust. So Buffett didn't call his lawyer or his stockbroker. He went out into the field and became an investigative journalist. He visited restaurants and hotels. He talked to cashiers. He asked them, "Are you still accepting American Express traveler's checks? Are customers still using the American Express card?" The answer, overwhelmingly, was yes. People still saw the iconic blue box logo and associated it with safety and reliability. He went to banks and spoke with tellers, asking if they were still selling the traveler's checks. They were. He observed that the scandal, as huge and as loud as it was in the financial press, had not permeated the consciousness of the average consumer or merchant. The halo effect we discussed earlier was so powerful that it was acting as a shield, protecting the core business from the rot in the peripheral warehousing division. He concluded that the fundamental earning power of the real American Express was completely intact. The salad oil scandal was a terrible, embarrassing, and costly problem, but it was a curable cold. It was not a terminal illness that had infected the heart of the business. Armed with this on-the-ground research, he made one of the boldest moves of his early career. He invested a staggering 40% of his investment partnership's capital into American Express stock. Over the next few years, as the company settled the lawsuits for a fraction of what Wall Street had feared and the power of its core franchise reasserted itself, the stock price soared, quintupling in value and cementing Buffett's reputation as a brilliant contrarian. This story is the foundational anecdote for a reason. It is a masterclass in separating the signal of the underlying business from the noise of the market's panic. The market's dramatic overreaction to the salad oil scandal can be explained by a pair of powerful psychological principles: the availability heuristic and recency bias. The availability heuristic is a mental shortcut that relies on immediate examples that come to a given person's mind when evaluating a specific topic, concept, method, or decision. Because the salad oil story was dramatic, scandalous, and widely reported, it was available in everyone's mind. It was the first thing, and for many, the only thing, they thought of when they heard the name American Express. The decades of trust, the millions of successful transactions, the global brand equity, all of this was mentally overshadowed by the fresh, vivid, and terrifying story of the fraud. Our brains are not wired to be statisticians. They are wired to be story processors. And the story of the scandal was far more compelling than the boring, long-term story of a well-run traveler's check business. Closely related is recency bias, our natural tendency to give more importance to the most recent events. For investors in late 1963, the most recent event was the stock price collapsing. They saw the ticker tape plunging day after day, and this recent price action confirmed the availability of the negative story. The narrative and the price action created a vicious feedback loop of panic. Investors didn't see a 50-year-old institution. They saw a stock that was down 10% today, down another 8% tomorrow. This recent pain and fear blotted out all other information. Buffett's genius was his ability to consciously override these cognitive biases. He didn't allow the vividness of the scandal or the recency of the stock crash to dictate his analysis. Instead, he forced himself to go back to first principles. He effectively asked, ignoring the noise of the past few weeks, what is the enduring value of this enterprise? By conducting his own primary research, he was gathering new, more relevant data that was not being reported in the headlines. He was replacing the easily available, recent, and emotional data point, the scandal, with a harder-to-get, more timeless and logical data point, the continued trust of consumers and merchants. This is a core discipline of the CEO mindset. A CEO can't afford to be swayed by the daily gossip or the stock price. They must stay focused on the long-term operational health of their business. As an investor, you must adopt the same mental discipline, actively fighting the pull of the available recent story and forcing yourself to investigate the deeper, more important reality. To apply this diagnostic skill in your own stock picking, you need a repeatable mental model. Let's call it the problem isolation framework. This is a step-by-step blueprint for analyzing a company in crisis. Step 1. Identify the core value-generating engine. Before the crisis hits, you should already know this from your initial 4 filters analysis. What is the one thing that makes this business a wonderful fortress? For American Express, it was the trust-based payment network. For Apple, it is the integrated ecosystem of hardware, software, and services, locked in by high switching costs. For Coca-Cola, it is the global brand and distribution network. You must have this clearly defined. Step 2. Define the nature of the crisis. You must be a doctor diagnosing a patient. Is the problem operational, like Boeing's 737 MAX manufacturing flaws? Is it reputational, like Facebook's Cambridge Analytica data scandal? Is it legal/regulatory, like a major antitrust lawsuit? Is it managerial, like a scandal involving the CEO? Or is it a fundamental technological disruption, like Blockbuster facing Netflix? Categorizing the problem is the first step to understanding its potential impact. Step 3. Assess the contagion. This is the most crucial step. Does the problem, as you have defined it, directly and permanently impair the core value-generating engine? In the case of American Express, the warehousing scandal, a legal and reputational problem, did not infect the core engine of the payment network. The trust remained intact where it mattered most. For Boeing, an operational problem, manufacturing flaws, directly threatened its core value proposition of safety and engineering excellence, a much more dangerous situation. For Blockbuster, the rise of streaming, a technological disruption, was a direct fatal attack on its core engine of physical video rentals. This is the terminal illness. You must be brutally honest in this assessment. Step 4. Estimate the duration and cost of the cure. If you have determined the problem is a curable cold, you must then act like a financial analyst. What will it cost to fix? For Amex, it was the eventual legal settlements. For a car company doing a massive recall, it's the cost of repairs and the temporary hit to sales. You need to put a number on it, even if it's a rough range. How long will the company be in the headlines for this? A quarter? A year? This helps you understand the period of maximum pessimism and allows you to quantify the problem's impact on the company's valuation. By systematically working through this framework, you move from a state of emotional reaction to a state of logical analysis. You replace fear with a structured inquiry. This is the key to differentiating a true buying opportunity from a value trap, and it is a cornerstone of any effective wealth management process for the serious retail investor. The antithesis to this disciplined diagnostic approach is, once again, the path of the 99%, the panic seller. The average investor operates on a simple, deadly heuristic. If there's smoke, there must be a fire, and my job is to get out of the building as fast as possible. They don't distinguish between a small fire in a wastebasket and a fire that has consumed the structural supports of the building. To them, all smoke is the same. When the news of Facebook's Cambridge Analytica scandal broke in 2018, the headlines were apocalyptic. The company was accused of mishandling the data of tens of millions of users. The CEO was hauled before Congress, and the #DeleteFacebook movement went viral. The stock plummeted nearly 40%. The 99% saw this and sold in a panic. The narrative was that trust was broken, and users would flee the platform in droves. But an investor using the problem isolation framework would have reached a different conclusion. Step 1. The core value engine. Facebook's power comes from the network effect. Your friends and family are on it, so you have to be on it. Step 2. The nature of the crisis. Reputational and regulatory. Step 3. Assess the contagion. This is the key. Did the scandal, as bad as it was, break the network effect? For most people, the social cost of leaving the platform and losing contact with their network was far higher than the perceived risk of their data being misused. People were angry, but they didn't leave. The core engine was not impaired. Step 4. Estimate the cost. The company paid a $5 billion fine to the FTC and invested heavily in security. It was a huge number. But for a company generating tens of billions in free cash flow, it was a manageable, one-time cost, a curable cold. The investors who made this diagnosis and bought during the period of maximum pessimism were rewarded handsomely as the stock went on to more than double in the following years. The 99% who sold at the bottom locked in their losses and missed the entire recovery. They failed because they reacted to the headline, not the business reality. They confused a terminal illness, like what happened to MySpace when the network effect actually did collapse, with a curable, albeit severe, cold. This failure to diagnose is the single greatest destroyer of capital for the average investor and highlights the immense value of a disciplined, contrarian investing framework. The direct financial connection between correctly diagnosing a problem and your financial returns is immediate and powerful. A temporary, curable cold creates a very specific and identifiable signature in a company's financial reports and valuation multiples. When a company is hit by a one-time crisis, you will often see a sharp, but temporary, dip in its financial performance. This might manifest as a large, one-time charge-off or restructuring cost on the income statement, which can make a single quarter's or even a single year's earnings look terrible. For example, a bank might have to take a huge provision for a bad loan, or a pharmaceutical company might face a large litigation settlement. The 99% sees the headline number of a massive quarterly loss and flees. But the discerning analyst using the framework understands that this is a non-recurring event. They will look at the adjusted earnings, or the free cash flow from operations, which often remains strong, to see the health of the underlying core engine. The market, in its short-sightedness, will often punish the stock as if that one-time loss is a new, permanent feature of the business. This is when the price-to-earnings PE ratio can become misleadingly high or even negative. The stock price falls, but based on the temporarily depressed earnings, it doesn't look cheap. This is when you must look at other metrics, like the price-to-sales ratio, or by comparing the current market capitalization to the pre-crisis normalized free cash flow. A terminal illness, by contrast, shows up differently. It's not a sudden shock. It's a slow, grinding erosion of the company's financial health. You'll see a multi-year trend of declining gross margins, indicating a loss of pricing power. You'll see a steady decline in revenue or market share, signaling that the moat is being breached. You'll see rising debt levels on the balance sheet, not to fund growth, but to plug operational cash burn. This financial signature of a business in secular decline is the clear sign of a value trap, not a buying opportunity. By learning to read the financial statements like a doctor reads a patient's chart, you can see the tangible evidence that separates the temporary ailment from the chronic disease. This analytical skill is what allows you to make high-conviction asset allocation decisions during a market panic, confidently increasing your position in a great company when its stock price is detached from its long-term earning power, leading to explosive portfolio growth when the market finally realizes the patient was never dying at all. You have now learned how to identify a wonderful business and how to diagnose its problems like a master clinician. You can see the fortress and you know how to tell the difference between a superficial crack in the wall and a fundamental flaw in the foundation. But there is a third, equally powerful force at play that you must understand and harness: the psychology of the crowd. Even with the best analysis in the world, you will fail if you cannot control your own emotions and, more importantly, understand and exploit the emotions of others. This brings us to the third pillar of the Buffett framework, the psychology of panic, engineering your mind to be greedy when others are fearful. This is perhaps the most famous of all of Buffett's sayings, yet it is the most difficult to put into practice. It requires you to act in a way that feels completely unnatural, to buy when every instinct in your body is screaming at you to sell, and to stand alone while the entire world seems to be running in the opposite direction. The ultimate demonstration of this principle in action was not a single stock investment, but Buffett's decisive actions during the darkest days of the 2008 financial crisis. In September of 2008, the global financial system was on the verge of complete collapse. Lehman Brothers had filed for bankruptcy, the largest in U.S. history. Merrill Lynch had been forced into a fire sale to Bank of America. AIG, the world's largest insurer, had been bailed out by the government. The credit markets were frozen solid. There was a palpable sense in the air that the entire economic order was about to unravel. Fear was not just a market sentiment, it was a physical presence. The stock market was in a freefall, and the talking heads on television were openly discussing the possibility of a second Great Depression. The public was terrified, pulling their money out of the market, out of mutual funds, and even out of some banks, stuffing it into mattresses and government bonds. This was not a problem with a single company. This was a crisis of confidence in the entire system. And it was into this maelstrom of pure, unadulterated panic that Warren Buffett calmly and deliberately strode, not as a seller but as a buyer. His actions were swift and highly public. First, in late September, he announced a $5 billion investment in Goldman Sachs, one of the most powerful investment banks at the epicenter of the crisis. This wasn't a simple stock purchase. He bought preferred stock that paid him a handsome 10% dividend, and he received warrants that would allow him to buy Goldman's common stock at a fixed, low price in the future. He was not just buying stock, he was acting like a lender of last resort, demanding and receiving extraordinary terms because he was the one with capital and courage in a world that had none. A few weeks later, he did it again, investing $3 billion in General Electric. Then, on October 16, 2008, he published an op-ed in the New York Times that would become legendary. The headline was simple and direct: "Buy American, I am." In it, he laid out his thesis with crystal clarity. He acknowledged the terrible headlines and the legitimate fears, but stated, in short, bad news is an investor's best friend. It lets you buy a slice of America's future at a bargain price. He announced that he was personally moving his cash out of Treasury bills and into U.S. equities. It was signaling to the world that while others were gripped by fear, he was acting with greed. Later, in 2011, when another wave of fear swept over the markets regarding the solvency of American banks, he made a $5 billion investment in Bank of America on similar, highly favorable terms. These investments were not just financial transactions, they were masterstrokes of applied market psychology. He knew that his reputation as the Oracle of Omaha carried immense weight. By publicly deploying capital when no one else would, he was not only getting incredible deals for Berkshire Hathaway, but he was also injecting a dose of confidence back into the system. The financial returns were staggering. Berkshire made billions on these deals, but the foundational lesson is even more valuable. At the moment of maximum pessimism, when the fear of the crowd was at a fever pitch, he did not get swept up in the emotion. He detached himself, relied on his long-term belief in the American economy, and acted decisively. He was the one sane man in a world gone mad. The intense, herd-like panic that gripped the world in 2008 is a textbook example of two of the most powerful forces in behavioral science: herd behavior and loss aversion. Herd behavior, also known as social proof, is our innate tendency to assume that the actions of others reflect the correct behavior for a given situation. On an evolutionary level, this makes sense. If you see a group of your fellow cavemen sprinting in terror, it's probably a good idea to start running too, rather than stopping to investigate for the saber-toothed tiger. In the financial markets, this instinct is a deadly trap. When investors see the market plummeting and everyone around them selling, the social proof is overwhelming. The feeling is, if everyone is selling, they must know something I don't. I have to sell too to protect myself. This creates a cascade, a self-reinforcing stampede that has little to do with the fundamental value of the assets being sold. The selling begets more selling, driving prices far below any rational valuation. This is compounded by the even more powerful force of loss aversion. Pioneering research by psychologists Daniel Kahneman and Amos Tversky has shown that, for the human brain, the pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. Losing $100 feels twice as bad as finding $100 feels good. During a market crash, investors are experiencing the acute pain of loss every time they look at their portfolio statement. This pain triggers the primitive, emotional parts of our brain, the amygdala, the center of our fight-or-flight response. The rational, analytical part of our brain, the prefrontal cortex, gets short-circuited. We are biologically wired to do anything to make the pain stop, and the most immediate way to do that is to sell. Buffett's unique mental wiring, or more accurately, his decades of conditioning, allows him to invert this process. He sees the herd running and recognizes it as a signal of opportunity, not danger. He interprets the market's pain not as a threat to his own capital, but as the source of his future returns. He has engineered his mind to feel a sense of excitement and greed when the emotional signals of fear are all around him. This is not a natural state. It is a learned, disciplined response that separates the master investor from the amateur. How can you, as an individual investor, hope to replicate this level of emotional control? You can't just will yourself to be brave. You need an applied mental model, an emotional pre-commitment strategy. Let's call it the emotional circuit breaker. This is a system you build during calm, rational times to protect you from your own worst instincts during a panic. Step 1. Create a panic watch list. This is a curated list of 10 to 15 truly wonderful businesses that you have already put through the 4 filters framework. These are companies you would be thrilled to own for the next 20 years. You do all the research now, when the sun is shining. You read the annual reports, you understand their moats, you admire their management. You become an expert on these specific companies. Step 2. Set predetermined buy prices. For each company on your list, you calculate its intrinsic value using a conservative methodology, which we will detail in the next chapter. Then you decide on the price at which you are willing to buy. You don't just set one price, you set a tiered system. For example, I will invest X amount if the stock hits price Y, and I will invest another X amount if it falls a further 20% to price Z. You write this down. You make a concrete, physical plan. Step 3. Automate where possible. Set limit orders with your broker at these predetermined prices. This can help take the final emotional decision of clicking the buy button out of your hands when the moment of truth arrives. Step 4. Execute without thinking. When the market inevitably panics and one of the stocks on your highly curated watch list hits your predetermined price, your job is not to reevaluate. It is not to turn on the news and listen to the pundits screaming about the end of the world. Your job is to execute the plan you made with a clear, rational mind. The analysis is already done. The decision is already made. All that is left is action. This emotional circuit breaker system acts as a firewall between the emotional panicking part of your brain and your investment capital. It short-circuits the fear response by replacing it with a pre-programmed, logical plan. This is how you can force yourself to be greedy when others are fearful, not through sheer willpower, but through intelligent system design. This is a core component of turning a speculative trading strategy into a professional-grade investment operation. The antithesis of this disciplined, prepared approach is the emotional whipsaw that the 99% of investors subject themselves to. Their journey is a tragic comedy of buying high and selling low. Instead of being greedy when others are fearful, they are greedy when others are greedy. The perfect recent example is the mania surrounding the ARK Innovation ETF ARKK, managed by Cathie Wood in 2020 and early 2021. During this period, the fund was a rocket ship, investing in high-growth, often unprofitable, disruptive innovation technology stocks. The stories were compelling, the returns were astronomical, and the media anointed its manager as a visionary. This created a powerful feedback loop of euphoria. Retail investors, driven by FOMO and the social proof of seeing ARKK's returns plastered all over social media, piled in. They were buying at the absolute peak of excitement, paying prices that were completely detached from any reasonable measure of fundamental value. This is the mirror image of the 2008 crisis: maximum greed. Then, inevitably, the tide turned. As inflation and interest rates rose in 2022, these high-flying, long-duration assets were crushed. The fund fell over 75% from its peak. And what did the 99% do? The very same people who bought at the top, consumed by euphoria, now found themselves consumed by the pain of loss aversion. They watched their investments evaporate, and at some point near the bottom, they capitulated and sold, locking in devastating losses. They were greedy at the top and fearful at the bottom, the exact opposite of the Buffett mantra. They had no system, no pre-commitment, no valuation discipline. Their entire investment process was dictated by the emotional temperature of the market. This is the guaranteed path to wealth destruction. It is why the average investor's returns consistently and significantly lag the market averages, like the S&P 500. They are their own worst enemy, perpetually buying into narratives at the peak of optimism and selling out of them at the trough of despair. The direct financial connection between mastering market psychology and your returns is best illustrated by the VIX, the CBOE Volatility Index. The VIX is often called the Fear Index. It measures the market's expectation of 30-day volatility. When the VIX is low, the market is calm and complacent. When the VIX spikes, it means fear and uncertainty are rampant, and investors are paying up for portfolio insurance. For a Buffett-style contrarian, the VIX is not a measure of risk. It is a measure of opportunity. A chart of the VIX over the last 30 years shows massive spikes during every major crisis: the 1998 Russian debt crisis, the aftermath of 9/11, the 2008 financial crisis, the Eurozone debt crisis, and the COVID-19 crash in March 2020. These moments of peak VIX were, without exception, the absolute best times to be deploying capital into the stock market. Buffett's investments in Goldman Sachs and his Buy American op-ed coincided almost perfectly with the VIX reaching its highest levels in history. By acting when fear was at its maximum, he was able to demand terms and prices that were unimaginable just months earlier. The financial impact is twofold. First, you buy assets at a much lower price. The P/E ratio of the S&P 500 was over 20 in 2007. By March 2009, it had fallen below 10. You were literally paying half the price for the same dollar of corporate earnings. This dramatically increases your future potential for capital gains. Second, and less obviously, volatility allows for opportunities beyond just buying common stock. As seen with Buffett's Goldman deal, when credit markets are frozen and fear is high, you can act as a lender, providing capital in the form of preferred shares or corporate bonds at very attractive interest rates, often with equity kickers like warrants attached. These are deals that are simply not available during calm markets. By training your mind to see a high VIX, not as a danger sign but as a sale sign on the stock market, you fundamentally alter your financial destiny. You turn the market's greatest weakness, its emotional instability, into your greatest strength, positioning your portfolio for massive growth when sanity eventually returns. You are now armed with a powerful trifecta of knowledge. You can identify a fortress-like business, you can diagnose its ailments during a crisis, and you have a framework for mastering your own emotions to act when fear is rampant. Now we must translate this knowledge into a specific, actionable number. It's not enough to know that a great company is on sale. You must know what constitutes a truly great price. This brings us to the fourth pillar, the mathematical heart of the Buffett strategy: the margin of safety, calculating your entry point amidst the chaos. This concept, first introduced by his mentor Benjamin Graham, is what Buffett calls the three most important words in investing. It is the principle that separates investing from speculation. A margin of safety means never paying what you think a business is worth. It means demanding a significant discount to your calculated intrinsic value. This discount is your buffer against errors in judgment, bad luck, or the unpredictable turmoil of the economic world. It is the bridge that connects a great business to a great investment. And the story that most perfectly embodies this relentless focus on a margin of safety is Buffett's 1973 investment in the Washington Post. In the early 1970s, the stock market was in a funk. The Nifty 50 era, a period where investors believed you could pay any price for a group of 50 large, blue-chip growth stocks, had ended in tears. The market was pessimistic, and newspaper stocks in particular were deeply out of favor. Wall Street saw them as old media dinosaurs, vulnerable to competition and labor unions. The Washington Post Company, despite its prestigious reputation, was no exception. Its stock had been hammered. But Buffett, applying his now well-honed frameworks, saw a completely different picture. He began by ignoring the stock price entirely. Instead, he approached the company as if he were going to buy the entire business outright. He did what he called a look-through valuation, analyzing each of the company's component parts as separate businesses. The Washington Post Company owned the newspaper itself, which was a dominant franchise in a powerful city. It owned Newsweek magazine. And critically, it owned 4 major network-affiliated television stations in large markets. Buffett started by valuing these assets. He knew the television business well and calculated, based on the cash flow they generated and what similar stations were selling for in private transactions, that the 4 TV stations alone were worth somewhere between $400 and $500 million. He then looked at the other assets, the newspaper, Newsweek, the real estate. He conservatively valued the entire enterprise at a minimum of $800 million. He believed this was a conservative estimate of its true, intrinsic business value. Only after completing this detailed bottom-up valuation did he look at the stock price. To his astonishment, the total market capitalization of the Washington Post Company, the price at which Wall Street was willing to sell him the entire business, was only $80 million. The disconnect was staggering. The market was offering him the entire company for a price that was less than the value of just the newspaper itself. The $400 million worth of television stations were essentially being thrown in for free. This was a margin of safety of monumental proportions. He wasn't just buying a dollar bill for 50 cents. He was buying a dollar bill for 10 cents. He began buying the stock aggressively, investing over $10 million, which was a huge sum for his partnership at the time. Over the next decade, the market slowly began to recognize the immense value he had seen. The stock would go on to increase more than 100-fold, becoming one of the most successful investments of his entire career. This story is the quintessential margin of safety anecdote. It demonstrates the process perfectly. First, diligently and conservatively calculate the intrinsic value of the business, completely independent of the stock price. Second, compare that value to the prevailing market price. And third, act decisively only when the market offers you a massive discount to that value. It is a simple, yet profoundly powerful, mathematical discipline. The reason most investors fail to demand a margin of safety is because they fall victim to a powerful cognitive bias known as anchoring. Anchoring is our tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. In investing, the most common anchor is the current stock price, or even a recent high price. For example, an investor sees a stock that has fallen from $100 to $60. They anchor to the recent high of 100 and conclude, "Wow, it's down 40%, it must be cheap." They are making a judgment relative to a past price, which has no bearing on the company's actual intrinsic value. The price could have been absurdly overvalued at $100, and it might still be overvalued at $60. The 99% are constantly anchoring to irrelevant price data. Buffett's method is designed to deliberately and systematically shatter this anchor. By starting his analysis with the business fundamentals, the earning power, the assets, the cash flows, and building his own valuation from the ground up, he creates his own, much more reliable anchor, his calculated intrinsic value. Only after this independent anchor is firmly established does he allow himself to look at the market price. This allows him to judge the price against his own work, rather than judging it against its own recent history. He is not asking, is the stock cheap relative to where it was? He is asking, is the stock cheap relative to what the business is actually worth? This simple reversal of process is a profound psychological hack. It frees him from the market's manic depressive narrative and allows him to operate purely on his own rational assessment of value. He forces the market to be judged by his numbers, not the other way around. This is a crucial mental shift for any retail investor who wants to move from amateur speculation to professional-grade stock analysis. So how can you apply this principle and build your own valuation anchor? For the individual investor, a full-blown, complex financial model can be intimidating. But you can use a simplified mental model that captures the essence of Buffett's approach. Let's call it the business owner's valuation. The goal is to estimate the present value of the cash the business will generate in the future. Step 1. Estimate future free cash flow. Look at the company's past 10 years of free cash flow per share. Free cash flow is the real cash the business generates that can be used to pay dividends, buy back stock, or make acquisitions. It's harder to manipulate than earnings. Project this out for the next 10 years. Be conservative. If the company has been growing its free cash flow by 10% a year, don't assume it will continue to do so. Maybe project 7% growth for the next 5 years and 3% after that. You want to be more pessimistic than optimistic. Step 2. Apply a terminal value. At the end of your 10-year projection, you need to estimate what the business will be worth. A simple way is to take the free cash flow from year 10 and apply a conservative multiple to it, say 10 to 15 times. This represents the value of all its cash flows from year 11 into perpetuity. Add this terminal value to the year 10 cash flow. Step 3. Discount back to today. This is the key. $1 in 10 years is not worth the same as $1 today. You need to discount all those future cash flows from year 1 to 10, plus the terminal value, back to their present value. What discount rate should you use? A good starting point is the rate on the 10-year U.S. Treasury bond, plus a few percentage points for an equity risk premium. Let's say the 10-year Treasury is at 4%. You might use a discount rate of 7 to 9%. The higher the rate you use, the more conservative your valuation will be. Summing up the present value of all those future cash flows will give you your estimate of the company's intrinsic value per share. Step 4. Demand your margin of safety. This is the final, crucial step. If your calculation tells you the business is worth $100 per share, you do not buy it at $95. You demand a significant discount. You set your buy price at $50 or $60. That huge gap between the calculated value and your purchase price is what protects you. If your growth estimates were too optimistic, if a new competitor emerges, if a recession hits, the margin of safety is the cushion that absorbs these shocks and still allows you to earn a satisfactory return. This process forces a for-entrepreneur's mindset, making you think about a stock's price only in relation to its future earning power. The antithesis of the margin of safety discipline is the most common form of valuation used by Wall Street and the 99% relative valuation. This is the practice of valuing a company by comparing it to what other similar companies are worth. An analyst might say Company X is trading at a P/E ratio of 15, while its competitors are trading at an average of 20. Therefore, Company X is cheap. This line of reasoning is riddled with logical fallacies. It's like a group of people at a fine art auction in 2007 trying to determine the value of a house. They might say, well, the house next door sold for $1 million, and the one across the street sold for $1.2 million, so our house must be worth $1.1 million. The problem is that the entire neighborhood, the entire market, might be in a massive speculative bubble. Valuing something based on other, potentially also overvalued, assets is building a castle on sand. It completely ignores the anchor of intrinsic value. This was the logic of the dot-com bubble. Analysts justified the insane valuations of profitless tech companies by pointing to the even more insane valuations of other profitless tech companies. Relative valuation is a tool for justifying momentum, not for discovering value. It anchors you to the mood of the market, not the reality of the business. The 99% use it because it's easy and it confirms their biases. It tells them that the stock they want to buy, which is going up, is still cheaper than its peers. The true value investor rejects this completely. They understand that the only valid measure of value is a company's own future cash-generating capacity. By insisting on an absolute standard of value and a significant margin of safety, they insulate themselves from the madness of crowds and the relative valuation games that always end in disaster. This discipline is the mathematical backbone of beating the S&P 500 over the long run. The direct financial connection between the margin of safety and your portfolio growth is the most powerful and direct in all of investing. Your return on an investment is not determined by the story of the company or the headlines in the news. It is, to a very large degree, mathematically predetermined by the price you pay. Consider a simple example. A great, stable business earns $10 per share in free cash flow every year. Investor A, using a margin of safety approach during a market panic, buys the stock for $100 per share. Their initial earnings yield is 10%. $10 of earnings divided by $100 of price. Investor B, caught up in the euphoria a year later, buys the same stock for $200 per share. Their initial earnings yield is only 5%, $10 of earnings divided by $200 of price. From day one, Investor A's capital is working twice as hard for them as Investor B's. Over time, as the company's earnings grow, this initial advantage becomes a chasm. The margin of safety is not just a defensive concept to prevent losses. It is an offensive weapon that dramatically magnifies your potential for capital gains. By buying at a significant discount, you are essentially front-loading your future returns. Furthermore, it gives you multiple ways to win. If your analysis is correct and the business performs as expected, the stock price will eventually rise to meet its intrinsic value, giving you a large return. But even if the business only muddles through and doesn't grow as fast as you hoped, because you bought it so cheap, you can still earn a decent return. And if you are completely wrong and the business value declines, your deep discount provides a buffer that can help you still get out with a small loss or break even, while the person who paid full price suffers a catastrophic loss. The margin of safety is the ultimate tool for risk management and return optimization. It is the final step in the buying process, the seal of approval that turns a well-analyzed idea into a high-probability investment poised for significant, long-term asset appreciation. You've done it. You've identified a wonderful business. You've waited patiently for a crisis. You've diagnosed the problem as a curable cold. You've mastered your emotions, and you've purchased the stock with a significant margin of safety. For most investors, this is where the story ends. But for the true master, there is one final, crucial pillar, one that requires a different kind of skill, not of analysis or action, but of inaction. This is the fifth and final pillar, the patience of a saint, the unseen art of holding through the storm. Buying a great company at a great price is only half the battle. The real fortunes are made by those who can hold on to these wonderful businesses for years, even decades, allowing the magic of compounding to do its work. This requires a temperament that is even rarer than the analytical ability to find bargains. It requires the ability to sit still, to do nothing, and to trust your initial thesis even when the market continues to scream that you are wrong. And there is no better testament to this principle in Buffett's own portfolio than his most famous and enduring investment, Coca-Cola. Buffett made his major investment in Coca-Cola in 1988. He had been a fan of the product his entire life, famously drinking at least 5 Cokes a day. But it was the business, not just the beverage, that captivated him. He saw a company with arguably the most powerful brand in human history, a global distribution system that was untouchable, and a simple product that required little capital investment to produce. It was a royalty on the thirst of billions of people. He had watched the company for decades, and the infamous New Coke fiasco of 1985 had only reinforced his belief in the brand's power. When the company tried to change its formula, The public outcry was so immense it was a national news story. Consumers didn't just drink Coke. They felt a sense of ownership over it. This was the ultimate moat. The stock market crash of October 1987 provided him with his opportunity. In the fear and turmoil that followed the crash, even the shares of a fortress like Coca-Cola became available at a reasonable price. Over a period of several months in 1988, Berkshire Hathaway invested over $1 billion to acquire a significant stake in the company. But the genius of this investment was not just in the initial purchase. It was in the unwavering decision to hold. Over the subsequent 30-plus years, Buffett has held on to his Coca-Cola shares through every imaginable storm. He held through the recession of the early 1990s. He held through the dot-com bubble of the late 90s when Wall Street was deriding him as a dinosaur for owning old economy stocks like Coke instead of tech darlings. He held through the 2000 crash. He held through the 9/11 attacks and the subsequent market turmoil. He held through the 2008 financial crisis, when Coke's stock fell by more than a third. He held through endless health scares about sugar consumption, through the rise of new age beverage competitors, and through periods of sluggish international growth. At any of these points, a lesser investor would have found a reason to sell. The narrative would have been, "It was a great run, but the world has changed. It's time to cash in and move on." But Buffett, having done his initial work and confirmed the durability of the moat, did the hardest thing in investing: nothing. He let the company continue to grow its earnings, expand its global reach, and consistently raise its dividend. That initial $1 billion investment has since paid him billions upon billions in dividends alone, and the capital appreciation has been immense. The Coca-Cola story is the ultimate foundational anecdote for the power of patience. It teaches us that once you've made a high-conviction bet on a truly wonderful business, your greatest enemy is not a market crash or a bad headline. It is your own restless desire to do something. The irresistible urge to constantly tinker with one's portfolio is driven by a pair of potent psychological biases: action bias and the illusion of control. Action bias is our innate predisposition to favor action over inaction, even when inaction is the more rational course. In many areas of life, this is a useful trait. But in long-term investing, it is a poison. When a stock we own goes down, our brain screams at us to do something. Sell it, buy more, trim the position. Sitting still feels passive, irresponsible, and lazy. We feel that by acting, we are taking charge of the situation. This is closely linked to the illusion of control, our tendency to overestimate our ability to control events. By constantly buying and selling, checking stock prices multiple times a day, and reading every news story, we create a feeling that we are actively managing our investments and influencing the outcome. In reality, this frenetic activity is usually counterproductive. We are like a nervous passenger on an airplane who keeps fiddling with the air conditioning vent, believing it somehow helps the pilot fly the plane. Buffett's temperament is the antidote to these biases. He calls his preferred holding period forever. His approach is one of masterful inactivity. He understands that once he has bought a piece of a wonderful business, the real work is being done by the thousands of employees of that company every single day. His job is to get out of the way and let them create value. This requires a profound level of humility and trust in one's own initial judgment. It requires consciously fighting the brain's desire for the dopamine hit that comes from taking action and replacing it with the quiet, long-term satisfaction of watching a great business compound. It is a mindset shift from being a stock trader to being a business owner. Owners don't sell their successful private business every time there's a bad quarter. They hold on and let it grow. You must adopt the same mindset with your public stock holdings. To cultivate this saint-like patience, you need a mental model that reframes the very nature of an investment decision. The most powerful one Buffett ever proposed is the 20-slot punch card rule. He said, I could improve your ultimate financial welfare by giving you a ticket with only 20 slots in it, so that you had 20 punches, representing all the investments that you got to make in a lifetime. And once you'd punched through the card, you couldn't make any more investments at all. Imagine the profound effect this would have on your decision-making. You would treat every potential investment with the seriousness it deserves. You wouldn't waste a precious punch on a speculative short-term idea. You would only use a punch on a business that you understood deeply, that had a durable moat, and that you believed in so strongly you would be happy to own it for a decade or more, even if the stock market were to shut down for the next 5 years. This mental model forces extreme selectivity and a long-term orientation. Before you buy a stock, you should ask yourself the punch card question: is this business so good, and is the price so attractive, that I am willing to use one of my 20 lifetime slots on it? This immediately elevates the decision from a casual trade to a significant, long-term commitment. It also helps immensely with the decision to hold. When the inevitable storm hits and the stock price falls, you can look back and say, I used one of my precious punches on this for a reason. My long-term thesis is still intact. The temporary noise doesn't invalidate the reasons I made this a lifetime commitment. The 20-slot punch card is not a literal rule, but a powerful psychological device. It is a blueprint for building a concentrated portfolio of your very best ideas and giving them the time they need to truly flourish. It is the ultimate cure for the action bias that plagues the average investor. The antithesis of this patient, long-term owner mindset is the hyperactive churning that characterizes the behavior of the 99%. The average holding period for a stock for an individual investor has plummeted over the decades, from years to mere months. The modern brokerage app, with its zero-commission trades, flashing green and red numbers, and gamified interface, is designed to encourage this behavior. It turns investing into a video game, rewarding action, and creating a constant sense of urgency. The 99% buys a stock. If it goes up 10%, they are tempted to sell and lock in a profit, cutting their winners short. If it goes down 10%, they panic and sell to cut their losses, often right at the point of maximum pessimism. They are constantly whipsawed by the market's daily noise, jumping from one hot trend to another. This constant activity, which gives them the illusion of control, is financially ruinous for 2 reasons. First, it prevents them from ever benefiting from the true engine of wealth creation, long-term compounding. They sell Coca-Cola after a small gain to buy a hot tech stock, never allowing the former to become the 100-bagger it's capable of being. Second, it racks up enormous, often hidden, costs. Even with zero commissions, every sale triggers a taxable event. The relentless churning turns what could be long-term capital gains, taxed at a preferential rate, into short-term capital gains, taxed as ordinary income. A massive and completely self-inflicted financial penalty. This is the behavior of a gambler, not an investor with a CEO mindset. It is a strategy guaranteed to enrich the brokers and the tax authorities at the expense of one's own financial freedom. The direct financial connection between patience and your ultimate wealth is the most beautiful and powerful force in finance, the magic of tax-deferred compounding. Let's quantify the impact. Imagine you invest $10,000 in a wonderful business that compounds at an average rate of 15% per year. If you hold it for 30 years without touching it, your initial investment grows to over $662,000. Now let's consider another investor who invests in the exact same stock but decides to sell at the end of every year to lock in their 15% gain and then immediately reinvests the proceeds. Let's assume a combined federal and state long-term capital gains tax of 20%. At the end of year 1, their $10,000 grows to $11,500. They sell, pay 20% tax on the $1,500 gain, $300, and are left with $11,200 to reinvest. They have already fallen behind. If you run this scenario out for 30 years, the active investor who pays taxes annually ends up with only about $275,000. The patient, inactive investor has more than double the amount of money. Why? because the patient investors' untaxed gains were left to work for them every single year. Their capital gains tax liability was deferred until the very end, allowing the full, unadulterated power of compounding to work its magic. Patience is not just a virtue. It is a massive, tangible financial advantage. It allows you to keep the government as a silent, non-interest-paying partner in your investment success for decades. By adopting the mindset of masterful inactivity, you not only improve your decision-making and reduce stress, you directly and dramatically increase your final portfolio value. This is the final, essential key to building true, lasting, and life-changing wealth. You have journeyed through the 5 pillars of the Buffett framework. You have absorbed a system for thinking that is radically different from the one used by the rest of the world. You no longer have to be a victim of scary headlines or a slave to the market's manic emotions. You now possess the diagnostic framework of the world's greatest investor. You have the tools to identify a truly wonderful business, the fortress with an unbreachable moat. You have the clinical detachment to distinguish between a temporary curable cold and a fatal terminal illness in that business. You have the psychological blueprint to be greedy when others are fearful, and the mathematical discipline to demand a margin of safety. And finally, you have the wisdom to practice masterful inactivity, allowing your wonderful businesses to compound for decades. This is more than just a stock market strategy. It is a complete mental operating system for rational decision-making under pressure. But it is crucial to understand that this framework, as powerful as it is, represents just one gear in a much larger interconnected machine. The Buffett philosophy is a network of mental models that support and reinforce each other. The principle of buying great companies with temporary problems is just one node in that network. How does this strategy of opportunistic buying connect to his ironclad rule of never lose money? How does the idea of a concentrated 20-slot punch card portfolio interact with the need for diversification? How do you manage the waiting period when your cash is sitting on the sidelines seemingly earning nothing while the market is roaring ahead? These are not trivial questions. They are the advanced applications of the core philosophy, the connections that turn a series of smart tactics into a truly bulletproof, lifelong strategy for wealth management. The answer lies in the next piece of the map, the next layer of the blueprint. The video that is now appearing on your screen is not a random suggestion from an algorithm. Think of it as the next logical step in your education, a deliberate choice to provide the missing link. It is the piece that connects the art of buying right with the science of risk management and portfolio construction. It addresses the critical questions that arise once you begin to implement the strategy you have just learned. Most people will stop here, satisfied with the powerful new tools they have acquired. They will have a significant advantage over 99% of other investors. But those who are truly serious about achieving complete financial freedom, those who embody the 4 entrepreneurs and CEO mindset, know that the journey is about building a complete and interlocking mental arsenal. The choice, as always, is yours. You can be satisfied with the foundation you have built today, or you can choose to build the rest of the fortress. Click and continue your ascent.